Today, we are going to look at a case study of an attorney who's interested in a whole life insurance policy set up for maximum cash value and flexibility. This would be a nice case study because this individual had done a fair amount of research before even reaching out. He wanted to understand the product and really wanted to know what questions to ask, what to look for, really wants to know if the policy is being set up in his best interest for maximum cash value, which in my experience is very common when working with attorneys or professionals that for a living really have to have a lot of attention to detail, or they're always examining the details and they know what questions to ask when they're approaching a situation, which I appreciate a lot. So what we'll start with actually is what he had reached out with. So we've got his initial email here, and here we go. He would like to set up a policy consult appointment. He's interested in setting up a policy for himself to maximize cash value. Now, this I absolutely love, where he lays out his initial policy criteria. So he's saying, here's what I want to do. 1090 split. That right there tells me he's really been digging into whole life insurance and knows what kind of questions to ask regarding the split. A 1090 split means we've got a 10% base premium. The base premium takes the biggest bite out of cash value initially, so he wants to minimize that. Look specifically at what it says, 1090 split, or as low as the provider is willing to go. So how do I minimize expenses and maximize cash value? We've got looking to add a minimum of $10,000 per year, but also go up to $100K per year for at least 10 years. Here we've got at least. You are going to see 10-year funding scenarios, but we do have the option built in where he can pay into it longer because he did specify at least 10 years, not just 10 years. Point number 3, looking for a flexible policy. So company selection is going to be very, very important here, but flexible policy so I can add beyond the 10-year mark if I want to. Now also, where flexibility is important in my opinion, and this is before we even connect over a call, but what he mentioned here, looking to add a minimum of $10,000 per year, but up to $100,000 per year. That tells me he does not want to be billed for $100,000 every single year. And that's where we go back to company selection and how flexible they are with respect to adding the minimum premium and then being able to add more money to the policy on top of it. We do need to set the policy up flexible to be very flexible in order to be able to do that. Then he's got here, to make the call most efficient before even meeting with him. I like him a lot, all about efficiency. Please provide a projection Excel sheet and a relevant policy contract sample from a major insurance provider you work with. So we provided 2 of the major mutual companies, being Mass Mutual and Guardian. So then he provides a little bit of information on himself. Look at that. He's next to Levi's Stadium. Maybe he's a 49ers fan, like myself. 35 years old, married, 1 child, occupation, attorney. Okay, so here's what I would put together in this particular situation. Here's what we got. 35-year-old attorney, interested in a whole life insurance policy for cash value. He also mentioned that flexibility is important. He wants a $10,000 minimum premium with the ability to go up to $100,000 per year. And we know for at least 10 years, but the ability to fund longer if he'd like. So 2 companies we put together here, 2 of your 4 major mutual companies, being Mass Mutual and Guardian, which I am a huge fan of, 1 for their flexibility, but 2, being the major mutual companies, we see that proof of strong actual performance, not just illustrated performance. An important item to hit, let's put this in purple, the topic of flexibility. So what is the difference in policy flexibility regarding Mass Mutual and Guardian when we compare the 2? Well, for him, we've got a detailed video we sent that goes through specific items as far as the differences. Quick overview is this. If I want the ability to pay in $100,000 per year, and I want a 1090 split, 10% premium, or lower, as low as the company can go, we specified that, you can do that with both of them. You can have a 10% minimum premium. Guardian even allows you to go 50x in the first year if someone has a large lump sum. But regarding payment flexibility, here's how it works. Let's begin with Mass Mutual because they're a little bit less flexible than Guardian. So in the first year, let me start with this before I get into the first year. MassMutual will allow him as a policyholder to adjust his payments one time per year, every year, provided that payment adjustment fall on his anniversary date. As long as he does that, we can avoid medical underwriting. Now, the policy must be set up properly with the proper riders and such. We've got other videos that go through that. But my point is, if we make the policy flexible, first year, he can pay in $100K. Let's say he starts out strong. Year 2, things are slower, and he only wants to pay in $15K. Say it's a little bit higher than the minimum of 10. Say 6 months later, he wants to add another $85,000 and get up to a total of $100,000. Can he do that with MassMutual? The answer is yes, but they may come in and say, hey, before we accept your money, we want to put you through medical underwriting. We want you to fill out paperwork. It can be a bit of a headache. A lot of people have expressed frustration here. Where MassMutual would work well in this scenario is not to pay it in 6 months later, but wait until the beginning of policy year 3. And at that point in time, we can adjust the payment and go back up to $100K. We can even adjust it up to $185,000, making up for lost time, meaning $100K for year 3, plus the unused $85,000 from year 2. The most important item to be aware of, however, is that one time per year payment adjustment. As long as the policy is set up appropriately, we need to have the lister rider specifically attached. If that's attached and we do everything right, we can make those annual payment adjustments without medical underwriting, keeping it very, very convenient there. Then we've got Guardian. They're a bit easier to explain. I can commit to that minimum premium of $10,000 per year. That can even be broken up over 12 months if I wanted to. So a little over $800 per month. And then 100% at leisure, I can throw more money into PUAs. Extremely flexible. And I can do that through my online portal, my mobile app. I can mail in a check. It can be a wire transfer. They are extremely flexible there. Now, I do need to set the policy up appropriately. If I use the right term rider, specifically their 1-year term rider, then we can illustrate 10x the base premium in PUAs all day long. If we don't have that attached, there's some more rules that I need to be aware of. In short, I can only go 3x. So again, technical details there, but my point is policies must be designed properly, especially if flexibility is important. Have awareness or have an agent that has awareness on this. So let's take a look at the numbers here. First, we've got MassMutual. We've got their 10-pay policy here. Their 10-pay policy accepts premium payments for how long? It's in the name. 10 years. So this is an option that I definitely want to show because when we look at the cash value performance, the IRR is attractive. When we compare it with other MassMutual products, it will be the strongest. So you've got the strongest cash value performance, and we've got a policy that meets his goal of funding it for 10 years, but what does it not meet? 10 years at least. If you want it to go longer, might not be an option, but if I'm him, I definitely want to see it. We're close to the same age. So annual funding, we illustrated here $100,000 per year for 10 years. First year cash value, this is because he's younger. Hard to see a clean 90% in the first year. And this was run at regular preferred, not ultra preferred, but strong right out of the gates, $90,000. Breaking even, year 4. I've paid in $400, I've got $402. Then I let that cash value ride over time along with the death benefit too. Attractive option. That 10-pay policy is strong. Now, if after looking at that and after having a discussion, if he says, you know, I'd really like the option to go longer than 10 years. I want to ask some questions, such as, how about 15 years? And why I would ask 15 years is MassMutual has a 15-pay product, which is similar to the 10-pay. The IRR is slightly weaker, but it's designed, MassMutual's 10-pay and 15-pay products were designed really for cash accumulation. So you see strong internal rates of return. So 15 years, he says, yeah, I would like that option. How about longer? 15 years will take you up until the age of 50. If he says, yeah, I'd like that option, then we would begin to look at other products where he could continue to fund indefinitely and compare them. That's if he's gravitating toward mass. My point is, when looking at larger dollar amounts, usually what we see is people do like to see at least 2 options, sometimes 3, just to know what's available, so I don't pick an option and then find out after the fact, man, Steve didn't show me option B. I've also learned not to show 18,000 options, as I sometimes have a problem with that. So here we've got Guardian's L95 policy with their 10% PUA fee. The 10% PUA fee is designed for stronger long-term cash value performance based on the non-guarantees, not the guarantees. Breaking even, year 5. What's the big difference? First year, $83,000 in cash value compared to that mass 10 pay, $90,000 in cash value. But look at the death benefit. That's a difference right out of the gates, isn't it? Yes, it is. Next, we've got Guardian's 5% PUA fee. I do like to show these two side by side because it's the same product with different PUA fees. We did have to add a little bit more term to this policy, but it's the same core policy when we look at it. Same whole life death benefit, same base premium, just a little bit more term, but earlier break-even point. And then we've also got that L95 5% PUA fee, but with the indexed rider demonstrated. And in a case like this, I will send a video that provides an overview of the indexed rider. And then of course, if he wants to discuss it, I'll talk through it as well. But it's a nice rider to add to a policy. What a lot of people like about it is you can attach it to a policy and you can set it at 0%. If it's at 0%, it functions as if it was never attached in the first place. So there's no fees or anything like that exercised if it's at 0%. But then if I want to flip it on in the future, I can do so. That's what we found a lot of people like about it, just in case I want to use it, even though I think I never will. It's nice to have, especially if it does not cost me anything when I'm not using it. If we turn it on, there is that fee that's exercised. And then lastly, what I would also show in a case like this is this. Here we go. Exact same thing, but with internal rates of return, both the annual and average. I wouldn't show this to everyone. It's really if it's requested or if I get the sense someone's really been digging in and doing a lot of research. He mentioned 1090, fund for at least 10 years, maximum cash value. A lot of times when someone mentions maximum cash value, in experience, they bring up the point of internal rate of return. So it's something that's nice to show. And how I have always liked to conduct business is start very broad and then begin to narrow things down. So for example, what may happen in a case like this is here we've got the IRR reports for the different options. Usually we see something like this. I like the MassMutual option. I like the Guardian options, but hey, we don't need to look at the indexed right now. I can attach it, that's great, but we don't need to see it. Of the 2 options here, I don't feel that I'm going to need as much cash value up front, but then I would ask, are the guarantees important? Or do you want to see the strongest possible guarantees? Because you would see that here. If he says, no, it's one of the major mutuals, let's focus on the 10%. Now we've got these 2 side by side. And then what we would do to layer on top of this, not to overcomplicate things, is look at the Guardian product with more funding after the 10th year, and then look at a MassMutual 15 pay or a different product that allows him to fund for a long period of time, meaning the last piece he mentioned, the flexibility of funding 10 years or longer, right? So it's at least 10 years right now, but if he wants to go longer, that'd be the one thing that we need to build into the current scenarios. But again, that was just a starting point. Reached out, it was apparent he did research. He provided information on his situation and asked for samples. So here's samples, 10 years to start, variety of products. Now we can begin to narrow things down. We also talked about the flexibility, which typically helps a lot during the decision-making process. Hope you enjoyed this one. I had a ton of fun putting this together. If you enjoyed it, please hit the like button, subscribe for more, and as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.